Amazon and Alibaba operate similar businesses just in different parts of the world. But which one is the better stock to buy for long-term investors? That's the question I'm going to answer in this video by comparing these two companies across a myriad of financial metrics, including revenue, cash flow, profit, return on invested capital. I'm also going to look at valuations. I'm going to compare the valuation based on the forward price to earnings ratios of Alibaba and Amazon, and discounted cash flow valuation models for Alibaba and Amazon. And at the end, I'll give you my answer for which one I think is the better stock to buy. Let's get started. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So over the last decade, Amazon has demonstrated superior growth to Alibaba, rising from a little over $100 billion in revenue all the way up to $620 billion in trailing 12-month revenue. Alibaba has reached a bit of a ceiling here. In 2022, its revenue capped or peaked at around $135 billion and has stayed there for the trailing 12-month period, going back a couple of years now. Alibaba has tried various strategies to reignite growth, and in recent quarters, growth has increased slightly based on changes to Alibaba's policies to improve the customer value proposition. Still, the countries that Alibaba operates in, primarily in China, have experienced slower growth and an increase in competition from rivals. Amazon, meanwhile, has dealt with competition more effectively than Alibaba has, and therefore it has retained and regained and accelerated revenue despite the challenges it faces. The next thing I wanted to compare these two on is the operating profit margin, and we see two different stories here. The first story we see is Alibaba's operating margins are declining from peaks of around 35% in 2017 all the way down to 12% in the most recent trailing 12-month period. Some of the more recent policies Alibaba has taken have brought down operating margins meaningfully. Amazon, meanwhile, has generated increasing operating margins as the company's revenue has grown up to 9.77% from being relatively flat in 2015 or close to zero in 2015. I like to see companies expanding their operating margins as revenue increases. That demonstrates that the revenue growth is coming organically, not as a result of lower prices or higher advertising or more salespeople, more spending on research and development. And so Amazon's demonstrated improvement in operating margins is a clear advantage against Alibaba, which has been heading downward over the last decade. A similar story with the cash flow from operations to sales. Amazon's been increasing while Alibaba's been on the decline. Amazon recently surpassed Alibaba with an 18.2% CFO to sales, while Alibaba is down to 12% or 16%, I should say. When we look at returns on invested capital, we get yet another point of evidence of that trend line continuing, with Amazon improving and Alibaba worsening. The return on invested capital measures how good a company is at taking investor capital and turning it into products and services that generate profits. This is less important for some companies and more important for others. For capital-intensive businesses like what Amazon and Alibaba operate, this is an increasingly important metric. They need to spend tens of billions, if not hundreds of billions of dollars in maintaining, expanding, and building these logistics networks, fulfillment networks, warehouses, and they also both operate cloud services segments that need significant capital investments, especially now with the rising effectiveness of artificial intelligence. They are both investing in expanding the availability of data centers optimized for artificial intelligence. And so you want to invest in a company that is good and effective at taking investor money, putting it into products and services that can generate profits. Amazon has demonstrated superiority in this regard. So across all of the metrics we compared Amazon and Alibaba, Amazon was superior in all respects. And so if they were trading at the same price, this would be a no-brainer. So let's look at valuation. So they're not trading at the same price. And I'm not surprised because Amazon is so superior to Alibaba in this regard. And then something we haven't talked about yet is the geopolitical risk that's embedded in Alibaba stock. The government in China is not as friendly to business as the government in the United States is. And so there's always that looming risk that there will be an increasing crackdown on the types of activities Alibaba is allowed to engage in and other various factors that adds risk to Alibaba stock geopolitically. Amazon, meanwhile, is trading at a forward price to earnings of 29, while Alibaba is trading at a forward price to earnings of 8.6. According to this metric, Amazon is about 3 times as expensive as Alibaba. Furthermore, if we look at the discounted valuation models, my intrinsic value per share for Amazon is 286 compared to 222 for the current market price. My intrinsic value calculation for Alibaba is 153, with the current market price being 83. So in both cases, Alibaba's stock is significantly more undervalued than Amazon stock. And while I agree both of these stocks are undervalued, I do have both of these stocks rated as a buy. If I had to pick just one of these stocks to buy, I would pay the premium and buy Amazon stock. I would pay that higher valuation and buy Amazon stock because Amazon, its earnings are of a higher quality and more sustainable. Its demonstrated ability to withstand competition, and you're getting lower geopolitical risks with Amazon stock compared to what you're getting with Alibaba. So because of those factors and those metrics we looked at where Amazon demonstrated superiority across the board, if I was to pick between these two, and I was forced to pick between these two, I would pick Amazon as the stock to buy for long-term investors. I'm curious to hear what you think, which one you think is the better buy. Let me know in the comment section below and let's start a discussion comparing these two. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.